What's up, everyone? It's Caddy with MoneyVest. So I hate to be the party pooper and a Debbie Downer on today's very, very green day, but that's who I am. I'm going to call it when I see it. So I wanted to go over the technical analysis a little bit on the markets and kind of show you a little bit of the data that is obviously suggesting. Again, I'm not saying it's going to happen, but it's suggesting that the risk reward is becoming more and more unfavorable on the long side as the markets continue to move higher. And look, I'm happy with today's green day. We're seeing a very, very nice move to the upside. I even shared this in the Discord in a funny manner, basically saying, let's see it, folks. Let the profit channels run today. Up a little over 17,000. Look, it's a fantastic day. I'm not complaining. We've got the volatility down over 4%. We got the nasdaq here up over 2%, with the S&P also pushing higher very nicely, up over 1.7, with the Dow Jones up over 100, actually over 480 points, and the yields dropping lower, down over 3.77%. This is great. This is phenomenal. But this is exactly what happens when markets rally. It kind of clouds our judgment, and bulls get trapped on these gap ups, and that's exactly what I'm here to discuss, is the market technicals and of course the RSI readings and volatility as well. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel. A lot of our links to our Discord and Patreon is going to be down below if you're interested in joining. There is a 16% annual discount that's going to be available till the end of this month, till the end of November. And again, we'd love to have you on board. Again, if you have any questions, please feel free to reach out, message me if you want to, ask any questions. And this right here is going to be, again, you get access to all the spreadsheets as well, which I'm going to go over in this video. So Excel spreadsheets are available, all the Discord channels with, over 20 plus Discord channels, including market discussions and trade ideas and alerts, and members only private videos, over 40 plus of them are also included. So CPI numbers came out very, very good, right? So we did get, absolutely no change in month over month CPI at 0.0%. We had year over year sitting at 3.2%, and month over month on a core basis, when you exclude for food and energy, we're looking at 0.2% as well. And on a year-over-year basis, core inflation came down to 4%. So every single number came in below what the consensus was, and that's really, really good. That's exactly what we talked about in our live stream. I mentioned that if we come in below than what the expectations are, the market's going to have a very bullish reaction. And that's exactly what happened. And even if you take a look at the CME FedWatch tool, what you'll notice is that the market's expectations of rates have changed, right? Not only have we increased the number of rate cuts, which are now expected to be four rate cuts priced in for 2024, but we're also expecting rate cuts to begin a little bit sooner than what we previously anticipated. So earlier, it was closer to June is when the rate cuts would begin. Now the market's pricing in the first rate cuts going to happen in May, in the first half of 2024, and they're going to see 1, 2, 3, 4 rate cuts in 2024. And that's the reason why the markets are rallying so much, so well, with a lot of individual stocks pushing higher. We have Tesla up over 4.3, Nvidia is up 1.5, we have Apple up over 1.2, not to mention, of course, a lot of other individual stocks like AMD is up 1.2. I've been buying SMH. SMH has been on this insane rally. It's up another 2% today, 2.6%. Very, very nicely up to $160. This right here has been the overall gain of over 18%. Not to mention VUG, which is also another ETF that I've been dollar cost averaging into, and buying is up almost 2% as well. So again, all the alerts are going to be down below if you're interested in joining our MoneyVest community. Now let's run through some data points, shall we? Let's talk first about the market RSI. Right, this is again going to be available for all the members. You can literally access these spreadsheets on your own and take a look at the reads and where we are. So if I reload this page, you'll notice that the current read on the S&P 500 on the RSI is 68.23. Okay, what does that mean? We've talked about this before. Market gets overbought when it's over 70. Market gets oversold when it's under 30. 30 and 70 are kind of like those thresholds for RSI. Now, what this means is that we are now approaching the 86th percentile, right? 86.68 percentile is where we are, which is still a normal occurrence. But the moment this crosses over 90 percentile, which in order for us to get to 90 percentile here, the S&P's RSI on a daily basis needs to be over 70. right? So you see this 90 percentile here and 70.15. The moment it crosses over 70, we are now in the 90th percentile for the relative strength index, meaning that we are now approaching very overbought levels. Right now we're at 67, 68, so we're still in the 85, 86 percentile at the moment, which is still, again, theoretically still in normal category, but we are much higher on the average basis, median basis, and of course on the mode basis, we're also very, very higher, right? We're a little bit on the overbought side. So look, the markets can be overbought for longer, but the higher we go, the more interesting it starts to become, because if you take a look at the days spent above 60, only 33.4%. And this is going back 22,000 days, almost 23,000 days, right? So if you basically think about it, 23,000 days divided by 252 is going to be over 91 years. We're going back as far as 1933. So this data that I've compiled together is going back as far as 1933, over 91 years. So total observations are 22,866. And of those observations, the amount of times the S&P is above 60 RSI is only 7,646. So that's only 33%, meaning a third of the times the S&P is over 60. Now, if it gets up over 70, look where we are, only 10.27%. So 90% of the times you spend time below 70 and over 10% of the times you spend with the RSI over 70. That just goes to show how rare these events are. And the moment that we are getting up to over 70 levels, I think it's time for us to be very cautious, optimistically cautious moving forward. This right here is volatility. Right now we're at 14.11. So I just want to double check that. 14.12. So this is getting updated live. So 14.11 is where we are. We're getting down to the 26.4 percentile because they move in opposite direction, right? So S&P is at 86 percentile. That's why the volatility is at a lower percentile of 26%. Still a normal occurrence, but the moment this drops below 25, I think is the threshold, or 25 or 20% is when this is going to switch from normal to rare, okay? That's exactly why these indicators are going to become more and more useful as the market kind of approaches those extremes and those tail events. And right now, with a 14 RSI, a 14 volatility, we're still at the lower bound. The moment it crosses below 14, we're going to be in the 25th percentile, and you can see days below 20, volatility is only spent majority of the time, 61% of times spent below 20, but below 10, right? Below 10. So between 10 and 20, that's where it's spent majority of the time, but below 10 is only 68 days out of 8,514 days. So this is going back as far as 34 years. If you take a look, less than 1%. Less than 1% of the times, volatility spends below 10. We're not there yet. We're getting down to 14. So another 4-point move lower on the volatility, and it'll be extremely low. And that's when this number will change to rare. It'll be under 10 percentile, and we'd be very much required to be cautious in this market, right? So these are the levels that I'm watching and paying attention to. Like inside this red rectangle is when I think it's going to be very, very interesting how volatility kind of fares up against a very overbought market. So you can see the S&P 500 here. On a consistent rally back up. RSI is 67 now, so pushing up. Starting to see a little bit of a pullback already. And not to mention the NASDAQ here with an RSI over 67.4. MACD also pushing higher. And I can't even begin to imagine what these individual stocks kind of look like with Apple here already at 68. Amazon also kind of like in a very similar boat as Apple with an RSI of 66. MACD also pushing higher. We've got NVIDIA, also in a very similar boat, 70 RSI, very, very overbought MACD. AMD kind of blasting off in space over 70. We got the MACD also higher. And Microsoft, God save Microsoft here, considering how overbought we currently are. And look, there might be some comments in this video, and I get this all the time when we talk about these technicals and market breadth and overbought, oversold conditions, that, the recency bias is what kicks in. And I think that's important for us to always be aware of, that these rallies and these moves will never last forever. Okay? If you ever believe that this one move is going to be, the direction for the stock or for the ETF or for the index or for the markets forever, think again. I would encourage you to think again, because that's not how markets work. They move in cycles. They get overbought, they get oversold, they get overbought, they get oversold. They make higher highs, higher lows. They make lower highs, lower lows. And that's the cycle that keeps on repeating itself, because that's how markets are created. That's the nature of market cycles. So that's all I wanted to go over in this video, and I may come across as a party pooper, but I think it's important for us to be cautious than to just blindly celebrate the rally that we're seeing. Again, it's one of those days where you want to refresh your portfolio every single minute to see how much you're up. I totally get that, but in the moment, we can't ignore that market technicals are certainly getting ahead of themselves right now, and I think it's important to keep in mind where we are. And what the market technicals basically look like with respect to volatility, with respect to overbought conditions, with respect to individual stocks, and then the valuation as well, right? So if you come over to the S&P 500 valuation, also one more thing I want to mention is the S&P 500 20 SMA, so SPX 20 SMA. So if you come back over to this chart, which actually will be updated after the markets close, because these update, they update after the markets close. But this right here is the index that I'm referring to, 66.2%. And this is percentage of stocks trading above their 20-day moving average. And I'm assuming after today, this is going to be well over 75%. And we're now going to approach those levels once again in terms of that short-term overbought conditions. And finally, if you take a look at the S&P 500's valuation, we're at 44.90 right now, which obviously puts us at just over just under 20 times price earnings multiples. We're approaching, a little bit under 20 times price earnings multiple as well. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. And as always, happy investing. I'll see you all in the next video.